Building on what we've previously discussed, the next topic is free cash flow. I want to just a brief review again is that we have a lot of information available to us, whether we're looking at the firm from an external perspective or an internal perspective. It's all about looking at information to be able to use it to make decisions. Now, we have the Form 10K. That has a lot of components. It has a management discussion, which talks about what the company is doing going forward, about the firm going forward, what the results were for this year. It's a discussion with management, a very important thing to read because it gives you background and insight into what's in the basic financial statements. Your balance sheet, statement of shareholder equity, income statement, cash flow statement. This is all supported by the notes to the financial statement. So one of the most important things is for you to read the 10K for your company. Read it. It should take you a good hour to read the 10K. Okay? And if you can take an hour to read the 10K, then there will be a lot of information there and you will become much more familiar with it. Somehow I'm figuring out how to incorporate those questions into the midterm. Haven't figured it out, but I will. The proxy statement is DEF 14A, and that's issued a little further along from the 10K, but it provides information on stock ownership, any issues before the board, the shareholders. It includes compensation. So that's sort of a background that I don't want you to lose sight of, okay? Because this is all within context of what we're doing long term. What is free cash flow? Simply, free cash flow is the cash available for distribution to investors. An organization really is in business to be sustainable, as we said, but it needs to generate cash, okay? And free cash flow is simply the amount of cash available from operations for distributions to all investors, okay? After making necessary investments to support operations, which would be changes in working capital and capital expenditures and such. So we have that, and the fundamental value of every firm depends on its expected cash flow. So when we're looking at this from an investment perspective, it's the ability of this firm to generate cash that I might want to consider an investment in it. There are 5 uses of free cash flow. First one, pay interest on debt, pay back principal on debt, pay dividends, buy back stock, buy non-operating assets. So now, this, if you go back to the statement of cash flows, this is what's done in the financing side, okay? With the exception of these marketable securities and non-operating assets. So these are the 5 uses that you want to consider. Okay, there's 100 different ways to calculate free cash flow. I'm going to share with you 3 because each one of them does something unique. The first one is what I'll call simple free cash flow. It's based on what we already discussed, and information can be obtained directly from the cash flow statement. So it's cash flow from operations less capital expenditures equals free cash flow. Very simple model. Now, what we move into is one that's a little more complex, and that I'm referring to is the free cash flow to the firm, FCFF. Okay? And that is the cash available to the company's suppliers of capital. This is after all operating expenses have paid and after all operating investments have been made. Now, when you remember that operating expenses includes interest expense. Now, interest expense is a payment, repayment, free cash flow to the firm, FCFF, not to be confused with simple free cash flow. And this is available, a more refined number of the cash available to the company's supplier of debt and equity. And Essentially, it takes into account all of the operating expenses before debt service. Okay? Debt service also includes interest. So that's an adjustment that's made. And after operating investments for fixed capital and working capital. We're still going to start with the same, if you're looking, there's my net income, non-cash charges, less working capital investment, cash from operating activities. The CFO has already added non-cash items to net income and deducted working capital investment. This is in the cash flow statement. So this is cash from operating expenses. To that, we need to add back interest expense because that's one of the uses of free cash flow. Okay? And that starts with interest expenses times 1 less the tax rate. This is because interest is tax deductible. So we need to gross it up when we add it back. And then fixed capital expenditures gives us free cash flow to the firm. It's a little more refined, and the refinement comes in is where it adjusts for the interest expense. Now, next is free cash flow to equity. Okay, that's the amount available to common stockholders. So that's after all operating expenses, all investments, but more importantly, after all borrowing costs have been paid. So in this case, we're taking out the funding side from a debt perspective. And this is how much is going to be left over for the company's shareholder. And you'll see that all of three of these produce a different number. Directionally, it should all be very, very close. But each one is a little more refined. In this case, we go through the same thing. We start with the cash flow from operating activities. Now, this time we don't adjust for the interest because we are looking for what's available to the common shareholder after. So we don't make that adjustment. We subtract out fixed capital investment, and then we add in new borrowing, or minus if the net debt payments, if it's negative. And that gives us the free cash flow for the common equity. Now, positive free cash flow, FCFE, means the company has an excess of operating cash over amounts needed to repay the debt. This is always a positive thing, but this is technically available for distribution to the shareholders, and the company has to make a decision to retain it, retained earnings, and to reinvest it in the company, or to get it back to the shareholders. So that's the free cash flow. What I'm going to do is this is really a good, I think it's a great piece, to help you understand free cash flow better, to see how it's applied. After the end of it, I'm going to come back and show you Geneseo Coffee Company. As always, please let me know if you have any questions.
Welcome to our next tutorial video. This time around, we're going to be looking at another very important concept known as free cash flow. And you're going to learn why it's important, what it means, how to think about it when analyzing companies, how to interpret it, what it means when you look at free cash flow for different companies, and also just at a more basic level, how you can derive it from companies' financial statements. And this is another topic where if you look at a lot of definitions online, yes, they give you the basic definition, but they don't really tell you why it's important or how you actually use it or how it impacts a company's valuation. So that's what we're going to focus on in this lesson. Now, you can see up here the table of contents, the different topics we're going to cover, what it is, what it means if it's positive, what if it's negative, why you exclude certain items from the calculation, how do you interpret it, and then we'll do a comparison at the end, and then a recap and a summary after that. Part of the reason this topic is confusing is because there are multiple different definitions. Different people define free cash flow differently, and it also depends a little bit on the industry you're in and the company. But the basic idea is very simple, which is what is a company's discretionary cash flow each year? So in other words, after earning its revenue, after paying its expenses to run the business, after paying for working capital items like inventory, which we covered in previous lessons, and after paying for capital expenditures, how much cash flow does the business actually generate? So let's look at a quick example using these simple financial statements. One way to calculate it, and the definition that we're going to use in this lesson, you see it down here, is that we're taking the company's cash flow from operations here on their cash flow statement, and then we are simply subtracting capital expenditures, we are ignoring everything else in investing activities. We are ignoring everything else within financing activities down here. So we're only factoring in operational items and then capital expenditures. And you might already be wondering why we're doing that exactly. Why do you leave out all these other items? And we'll get into that as we progress through the lesson, but I just wanted to lay out the basic definition and show you a calculation for this online training business company that we've been using in these examples so far. The reason why this number is important is because it speaks to the core problem that you have as a manager when running a business, or that you have as an analyst when analyzing a business, which is what should the company be spending its money on? So if the company generates a lot of cash each year and it's not using it on expenses, it paid for its capital expenditures already, so it doesn't need to spend anything else on those, it has a lot of different options. Should it hire more employees? Should it spend more on working capital items like inventory? So should it prepare to grow in advance so it can sell more later on? Should it actually spend more on capital expenditures and buy more factories or buildings or equipment because it thinks it's going to boost its long-term growth? Should it invest in other assets? Should it put money into securities or real estate or other types of investments like bonds to do something with its cash and earn interest? Should it repay outstanding debt? Should it issue dividends or repurchase shares to return money to the shareholders of the company? Or should it make more acquisitions? And there are other items. These are just some of the basic options that it has. But the point is that if a company has free cash flow and it's positive and it's actually growing by a good clip each year, it needs to start thinking about these issues. And you as the analyst looking at a company need to start looking at these and saying, okay, what is it most likely to do? Is it going to give in and issue dividends because it really doesn't know what else to do? Is it going to keep reinvesting it into its own business? Is it going to make acquisitions with its excess cash flow? And that is why this metric is so important, because it gives you an indication of over time how it's been changing and what the company may do in the future. There's no simple answer. These are just really possibilities. And it's your job as the manager or as the analyst to figure out what is most likely and what makes the most sense for the business. What if it's a negative or a very small number? Well, the first thing is you have to see if it's a recurring problem or a one-time issue. Because in a lot of cases, companies will have free cash flow that is negative because of a one-time event. So is it because the company is consistently spending too much on its operating expenses? Is it because its working capital is not being used efficiently? Is it because its business model is broken? And then once you assess that and dig in, then you can think about ways to fix it. So does the company need to raise debt or equity to cover its spending? Does it need to restructure itself, cut expenses? Does it need to change its business policies? Once you know that, then you can start making those types of recommendations. So that's a little bit about what to do when it's positive and negative. And we've covered 1 through 3 in our table of contents here. So let's move to step 4. Why do you exclude certain items such as investing and financing activities other than Capex from the FCF calculation? The easiest way to think about it is that most of what's in these sections is optional and it's not truly required for the core business to run. So if you have a business selling online courses as we do, you don't need to raise debt or equity to sell those courses. That's just a way to fund the business operations, but it's completely different from an item like deferred revenue or accounts receivable, which speak directly to what customers are paying us and what we're collecting in cash for the business, for the products that we sell. So these items in these sections are more optional and they're not truly required. And sometimes, yes, we have a need to expand, maybe we need to raise money, maybe we need to do something like that, but on an ongoing basis, they are generally not recurring items. If they are recurring, they're not predictable, they don't necessarily follow a clear pattern, and they're really discretionary uses of cash. We have them because we can say, okay, well, we have extra cash, let's pay dividends, or let's pay back debt, or maybe if we need more cash, or if we want to raise more cash, we can say, let's raise equity, or let's raise debt, but we don't really need to do it. The only things that are really required to run most businesses are paying for cost of goods sold and operating expenses, and paying for working capital type items, and also paying for required capital expenditures. Now there are some charges that are borderline, such as D&A, such as write-downs, such as interest, income, and expense, and the treatment of these sometimes varies, especially with interest and debt repayments, and we'll get into that later on. But in our view, the best thing to do is to factor in the tax savings from these, which is included in the cash flow from operations section, to leave in interest, income, and expense, at least when you're analyzing a company on a standalone basis, but to not include debt repayments for now, because it's not always clear if these are required or not, and we have to dig into that further. So in our view, the best definition for free cash flow is cash flow from operations minus capital expenditures. There are many variations of this. In a DCF analysis, you will use different variations, and we'll look at that later on. But when analyzing a company on a standalone basis, this is a pretty good definition of what you're looking at. And a lot of companies do define it exactly like this on their financial statements. So going up to our statements here again, you can see why we've included these items. All these non-cash charges, depreciation, amortization, stock-based comp, goodwill impairment, these are all tax savings types of items, because remember, they've hit our income statement over here. So they've reduced our operating income, or they've reduced our pre-tax income. So we've gotten the tax savings from these items, but they're non-cash. And so we get that tax savings, and by adding them back here, we capture that tax savings. The next section here, change in operating assets and liabilities, all these are related to our core business. Collecting cash, ordering inventory to sell in products, paying for expenses in advance, paying suppliers and vendors. We need all these to continue running our business, so they should all be part of the calculation. And then capital expenditures. We are investing in offline assets like equipment, maybe classrooms, renovating classrooms, things like that. So we need to include this as well. These other items, we don't really need to be buying or selling short or long-term assets. We don't need to be raising debt or equity or issuing dividends or repurchasing shares. In some of the previous lessons, we pretended that those were required, but the truth is you don't really need to do anything if your company is generating healthy free cash flow. So that takes us to the end of step 4, which is why you exclude certain items. Now step 5, how do you use and interpret free cash flow when analyzing and valuing companies? Let's go down and take a look at this. So at a basic level, use it in a couple different ways. In a discounted cash flow analysis, you value a company based on the net present value of its cash flows in the future. So you're going to project free cash flow, you're going to modify it, and it is going to be different from the definition here, just to be very clear about that. But you'll use a variation of this and use that to see what a company might be worth. Now in a leveraged buyout analysis, the use case is a little bit different, because here what you do is you use it to figure out how much debt the company can repay each year. And it tells you in turn, if you know how much debt it can repay, it tells you how much you can pay for the company up front, how much you have to contribute in cash for the company, and then how much you can raise in terms of debt to buy the company. So that's another use case. And then another use case here is standalone analysis, just looking at a company's statements, doing some financial statement analysis. And a couple important things to look at here. Obviously, you want to see if a company's free cash flow is growing or declining each year, and also the rate of growth. Is that declining or growing? What's driving the growth? Is it because they're selling more? Is it because they're increasing their prices? Is it because they're reducing their expenses? Is it because they are spending more or less on Capex? Is it because they're changing around their working capital policies? So you have to look at all that and see what's really driving it beyond just the high-level number. And then based on those trends, it's your job as an analyst to figure out how free cash flow may change in the future and what it says about the company's business. Now, the best case scenario here is that a company's free cash flow is growing because it's selling more. So going up to our example here, this is 700,000 revenue. So if this is going to increase to 800,000, and that's because we've actually sold, say, 1,200 copies of our courses instead of 1,000 copies of the courses, well, that's a positive sign because it means that we're selling more. We're not even increasing prices. We're genuinely selling more because there's more demand in the market. We're doing a better job marketing and selling them. We could also see this because we have higher margins. So maybe we're growing revenue more quickly than we're growing expenses because of economies of scale. Not all our expenses are going to scale up linearly with revenue. So those are also positive signs. Now what's not as good is if free cash flow is growing because of creative cost cutting. So maybe we're cutting expenses that are actually essential for our long-term success. And for now, free cash flow is growing, but it's not sustainable for the long term. Or maybe it's growing because we're investing less into Capex, and so we're reinvesting less into our business each year. So that's also not as good. And then real warning signs are if a company's free cash flow is growing even when sales or profits are falling, or maybe it's playing games with working capital, maybe it's playing games with non-cash charges and how it recognizes depreciation, or it's slashing Capex, or it's earning more from its non-core business activities, and that's what you really want to look at. If revenue and net income and free cash flow are not all moving in the same direction, that's usually a sign that something unusual is going on, or maybe something negative is going on. So that's when you really have to dig into this in more detail. Now, the interpretation here, you can't really say much because we only have 1 year of data, but what is interesting is, I'll go up and show you this again, free cash flow of 180. So this exceeds our net income here. So it appears that our business is throwing off more cash than we'd expect from just looking at the income statement. We can see some of the changes in working capital here, that overall we're spending more in assets than we're getting from liabilities going up. So what's the interpretation of this based on some of those numbers? Well, working capital is costing us money. It's common with a lot of businesses, but here it's about 10% of revenue, which is on the high side for this type of business, something this small. we're spending under 10% of revenue on Capex, which is probably about on par for this industry if we consider it to be the internet or software industry, although we need more data to really weigh in on that. So it's sort of an ambiguous conclusion here. We don't really have multiple years of data, so it's not possible for us to gain a whole lot of insights into the business. We can just at a basic level see some of what's going on here, but to really draw a conclusion, you need to see how free cash flow is changing over time. So with that said, let's actually now move into the next step of this analysis. So step 6, the free cash flow comparison and interpretation for Walmart, Amazon, and Salesforce. Once again, I have excerpts from all 3 companies' financial statements. I have highlighted some of what is important on their financial statements here, on their cash flow statement specifically, if you want to go in and get these numbers for yourself. So these are all highlighted for you. Let's start with Walmart here and do some interpretation of their numbers. So if we define free cash flow as cash flow from operations minus Capex, we can see here their cash flow from operations is for the most part going up each year until it falls in year 3. Free cash flow is jumping all over the place. Revenue is going up overall. Net income is mostly going up, although it's also fluctuating quite a bit. And if you look at some of these growth rates here, you can really see how free cash flow is actually jumping around a lot. Capex is a percent of cash flow from ops. It's jumping around a little bit between 50 and 60%, but relatively it's staying in that range. It's still about 3% of revenue each year. Revenue growth rate, still growing revenue at a fairly solid clip. Net income is jumping around a bit. Cash flow from operations mostly going up until year 3. So what's the interpretation? Well, it seems like free cash flow is all over the place. Cash flow from operations, though, is mostly growing, except for the decline in year 3. And if you dig into this, you can see that it's because accrued taxes flipped and became a negative because they finally paid those taxes in year 3. So we would argue that overall, cash flow from operations has really been growing on an organic basis here. Revenue is certainly growing over time, but working capital and Capex impact free cash flow in a huge, unpredictable way. The company's not exactly playing games with its working capital, but it did do something significantly different in year 2 because look at this. In year 2, the change in working capital of around negative $1 billion, that's much lower than it was in the other years. And then as a percent of revenue, it's also significantly lower in year 2. So we're not sure whether we should completely buy into these numbers. We would probably say for Walmart that it's a case of a company having a lot of one-time and unusual items, and that's impacting results here. So we would really need to dig into this further. Bottom line is that organic sales growth is definitely there. We don't believe that it's contributing to most of what's happening with free cash flow. So there's some contribution, but a lot of what's going on here is also because of Capex and working capital. So not exactly a negative interpretation, but also not super positive. This one, we'd really need to do more research and dig into their statements and see what is explaining some of these inconsistent changes and how it fluctuates so much over time. Now to Amazon. So here, we have a very different scenario. Cash flow from operations is generally going up each year. Free cash flow is fluctuating mostly because Capex, take a look at this. They dramatically increase their Capex spending in years 2 and 3 here. And if you look at their change in working capital, their change in operating assets and liabilities, these change overall by less than Capex. And if you look at some of the numbers here, so Capex as a percent of cash flow from operations, look at how much this is varying each year. 46% to 90% to 63%, it's all over the place. Free cash flow overall is declining in the first 2 years and then increasing a lot in year 3. The net change in working capital as a percent of revenue, that's actually going down over time. What's interesting to note, though, is that revenue is growing at a good clip, 40%, around 30%, 20%. Cash flow from operations also growing, at least the growth is positive each year. So we have that. And so our conclusion here is that the company's organic growth is also leading to growth in cash flow from operations. So it's not as if they're playing games or doing something unusual with working capital or non-cash charges. So it really is flowing down to cash flow from operations for the most part. But Capex is jumping around so much that it's hard to say anything substantial about free cash flow. There's a huge ramp up in spending in the past 2 years. Revenue is growing at a good clip. Cash flow from operations is also increasing, but Amazon is spending a huge amount on future growth, and that is actually dragging down net income. It's also increasing Capex here by a good amount. So as investors, we would look at this and say, okay, well, we understand that, we understand the reasoning, but is it really a good investment? Is all that Capex spending actually doing something useful here? And we don't know. We need to do more research on it, but that would be the main takeaway from this analysis. It's not exactly playing games with working capital, but it is interesting how much the items have changed over time. The accounts payable changes here really stand out because these are big, and it raises the question of how is Amazon changing its policies in terms of paying out to vendors and suppliers over the years? How has that been changing over time? How will it change in the future? So those are some of the conclusions we can draw for Amazon. Now to our final company over here, Salesforce. Let's take a look at this. Another interesting case, because this is really a software company, so its spending requirements are much different than what they would be for a retailer like Walmart or Amazon. Cash flow from operations is growing by a good clip each year. Free cash flow is also growing each year, although it slows down quite a bit in year 3. Working capital here, it swings around a little bit, but overall it's very positive because of the deferred revenue. They're collecting a lot of cash upfront for monthly subscription revenue that'll be recognized later on. Annual revenue is growing by a good clip, and net income is negative here, but a lot of that is just because of the way software companies work, and especially these subscription companies, where it takes them a long time to recognize the full benefit of winning a new customer. What I want to draw your attention to are a couple things. Free cash flow growth rate, so you can see it right here. Capex as a percent of cash flow from operations, much more steady than it was for Amazon, around 25% to 34%, 35% each year. Capex as a percent of revenue dips in year 2 and then goes up again in year 3. Revenue growth, around 30 to 35%, 36, 37% each year. And then cash flow from operations growth, this is also in roughly the 20 to 30% range. So overall conclusions, it seems like revenue growth really is falling down to cash flow from operations growth. And it seems like free cash flow growth is also a little bit more consistent here than it was for the other companies. So our interpretation, free cash flow is genuinely growing on an organic basis driven by sales going up. But we don't really buy the year 2 number because Capex as a percent of revenue also fell by quite a bit and then rose by quite a bit in year 3. So something a little funny is going on there. It is genuine revenue growth because it's flowing down to cash flow from operations. It's not manipulating numbers with working capital because cash flow from operations is growing. One interesting point, though, is that Salesforce has been spending a lot on acquisitions. If you look at their statements, business combinations, net of cash acquired, look at some of these numbers. 2.6 billion, 579 million, 422 million. So this raises the question of, are they going to keep doing that? Because clearly they have quite a bit left to spend on this after paying for Capex, because their free cash flow is positive each year. So they have some extra funds to spend on this. It also raises the question of what are their future Capex plans? It has fluctuated a little bit historically, so what is it going to do going forward? If Capex as a percent of revenue is going to stay low, it's possible that the company is going to still spend a lot on acquisitions, or maybe even start issuing dividends or repurchasing shares in the future. If, on the other hand, they're going to start increasing their Capex spending, well, they're probably going to spend less on acquisitions in the future and less on those other potential uses of cash. So that's it for our interpretation of these 3 companies and their free cash flow numbers. To recap what we did in this lesson, first you learn what free cash flow is, why it's important, what it means if it's positive, possible ways to use it, what it means if it's negative and what to do about it, how to dig into it a little bit. Then you learned why you exclude certain items, such as many of those in the investing and financing activities section, from the calculation. You learned how to use and interpret it when valuing and analyzing companies. Then we did this comparison just now between Walmart, Amazon, and Salesforce. So for our final recap and summary here, free cash flow is roughly cash flow from operations minus Capex. It's really the company's discretionary cash flow. So after paying for the required expenses, how much does it have left for other uses? After it pays for employees, should it pay for more employees? Should it spend more on Capex, more on acquisitions? Should it repay debt? Should it invest in other assets? Should it buy other companies? Should it issue dividends or repurchase shares? Should it spend more on working capital? Or if it's negative, does the company need more funding because it has a cash flow shortfall? It's used in a DCF analysis and LBO analysis. It's used in standalone growth and financial statement analysis to figure out a company's value, to figure out how much debt they can repay, and what it could do with its excess cash. It's really important to dig in and see what's driving free cash flow. Is it organic revenue growth? Is it expense cutting? Is it Capex or working capital changes? The best case is when it's really organic sales and economies of scale that are driving growth. So its revenue is going up, its expenses as a percent of revenue are falling over time. That's the best case scenario. It's less good when it's inconsistent or when it's a lot of unnatural expense or Capex cutting driving it. Even worse is when the company's playing games and using accounting gimmicks to impact its free cash flow and distorting the real picture. And we'll see many examples.
We're back over to the Geneseo Coffee Company, looking at the free cash flow, all 3 methods. First one is a simple free cash flow. Cash flow from operations, less capital expenditures. So if we look, this is for the year end 12/31/2015. Where do we get to cash flow from operations? Well, that's financial C59. So if we go back over here, right there, okay? So you can now see that $325,000 is our net income. We've added back the non-cash and the changes in working capital. So that gives us $325. Where do capital expenditures come from? Same place. They come right from purchase of property, plant, and equipment, $425. And we add them together. Now, one of the things that I can do, and this is where you sort of got to, as we start using Excel, it's pretty easy for me to calculate out the next year because I've laid out the information and I just, boom. So now we see that between year to year, what happened is the simple free cash flow went from being positive to negative, but we can evaluate that into what happened here. Okay, they bought a lot more equipment and in operations. But when we look, the real increase is in the working capital. Why the working capital? Sales are going up, and that's part of the process. So that's okay. That's not a bad thing. So now we move down to free cash flow to the firm. We start with cash flow from operations, which I simply bring down from above. Interest expense before the tax benefit. Remember, interest is tax deductible. So now I go over to my financials. Where am I going to find interest? Right here. Okay, so the interest is right on the income statement. So I bring that over. Now, there is a tax benefit. So I can't just add back that because this is after taking the deduction for that benefit. But since we're looking at it with available to the firm, which would be enabled to pay back interest, we add it back. So that's 38,000 times 11.4. Okay, capital expenditures. Cash flow to the firm is 723. And you can see that that is fairly consistent. So what we're going to do is I'm going to copy again. This time, 26.5, so we're seeing this positive, okay, cash flow, which is consistent with that, but we know why. Now, I'm going to do the exact same thing here. And you can see it's 30. Okay? So these are the three methods of computing cash flow. So next step here, this is the lectures. We're going to do two things. One, you're going to have an assignment. And number two, I'm going to walk you through destination Excel worksheets. Please let me know if you have any questions.